let's say that it's back in elementary school. We've got a teeter-totter here. We got a great big kid, and his name is Frank Price. We have two smaller kids on this end, and they're always together. Their name is yield and rate, interest rates. Now, if you know the direction of one of these kids, you're going to know the direction of the other two. And this is kind of what happens. The head of the Federal Reserve raises the discount rate. So interest rates go up. That makes existing bonds in the secondary market drop in value in order to yield the higher rate, which then raises the yield higher. So you have rates going up, then yields are going up, and they're always going opposite to price. Now, a short-term bond is like a short teeter-totter. It doesn't move very much. But a long-term bond is like a much longer teeter-totter, and there's going to be a lot more fluctuation in yields and prices on long-term bonds and very little change on short-term bonds. So if you don't want much change in principal, buy short-term. Problem is, within a short period of time, the bonds are going to mature, and you have your money back and you have to reinvest it at whatever the current interest rates are. So let's talk about the risk with different bonds. Short-term bond. You get stable principal, but you get a fluctuating rate of return. So if you rolled over Treasury bills, for instance, you'd have stable principal, but a fluctuating rate of return. You buy a long-term bond, you've got stable income because you're still going to get the coupon rate throughout the life of the bond. But during the life of that bond, interest rates are going to go up and go down. And so your principal is going to fluctuate in the secondary market if you had to sell those bonds. If you hold them until maturity, of course, you will get your principal all back again. Real case that I know of was someone who sold their house in California, got a ton of money in their pocket, and went to Texas. And they went to a broker and said, well, we bought some land outside of Dallas that in 4 years we want to build a house on. But in the meantime, we're just going to rent and get to know the area. And we'd like to take this nest egg that we have from selling our house in California and get some income on it. So the broker put them into a investment-grade bond fund made up of investment-grade long-term bonds. And they got a monthly check for interest. 4 years later, when they went to sell their bonds to build their house on their land, their bond fund was worth $80,000 less than it had been when they bought it. And they felt that the broker or the brokerage firm owed them the $80,000 because the broker knew that they needed that money intact in 4 years when they were going to build their house. But the broker had put them into a long-term bond fund. And obviously during these 4 years, interest rates had gone up, which had made the principal go down. Thus, they selling now out of their fund would be an $80,000 loss. Who screwed up? Well, the broker screwed up. What should the broker have done? And the answer would be, put them in something that matures in 4 years or less, but not a long-term bond if you know you need your money intact in a short period of time, because principal in the secondary market will fluctuate. And they had to sell out when interest rates were higher. Thus, they took an $80,000 loss. And as I understand, the end of the story is that they got their $80,000 plus interest that they lost on that investment. And it was the broker suitability that had been mixed up. Even though they've been put into a high-quality bond fund, it was the wrong term. Now, when you run the risk of interest rates changing and affecting the value of your bonds, that's called interest rate risk, and it's most severe on a long-term bond. I think another thing that is risking on long-term bonds is the fact that over time, the quality of the bond can change. After all, there was a time when I think General Motors was rated AAA 25 years ago, and I don't know what the rating is now. Last time I heard it was below investment grade. So if you'd bought a 30-year bond, what started out as a high-quality bond is now below investment grade. So over time, things can change. And you have inflation risk on a long-term bond. The fact that the $1,000 you're going to get back at maturity won't buy what $1,000 did 30 years earlier or 25 years earlier when you put the money in. So if they ask you a question, if the primary concern for an investor is inflation or purchasing power risk, what should you do? And they offer you long and short-term alternatives. The answer is short-term. Now, we could argue that point, but that's what they're looking for. So if they give you money market, good answer. If they give you money markets, funds, that's good. Short-term, 1 year, debt, rollover, treasury bills, for instance, that would be a good answer. But pick the shortest of the debt if they give you 4 answers in debt. If they gave you long-term debt and a bond common stock fund, if you look at what common stocks have done over the last 25, 30 years compared to an investment in bonds, you'd have been much better off in common stocks. So if your primary concern is inflation and common stocks are offered as a choice, pick it. That's it for bonds. A lot of questions on it. You want to do as many questions on bonds as you can lay your hands on. We have a number of them at the end of our chapters. We have a number of questions in our other exams. If you bought the disc of test questions, you can set it to ask you just bond questions. It's a great way of increasing your score. There's a logic behind bonds. You're buying income. You're saying, how much would I pay for this much income with this much risk? That's really what bonds come down to. And do these bonds do what I need? Do they fit my situation? If I'm retired, do they give me safe income?